Japan's government debt is big. As of this year, 2022, Japanese debt is 266% of GDP, by far the largest in the world, outpacing the rest of the developed world by more than 100 percentage points. This may come as a surprise. Japan is both a famous exporter, as fleets of Toyota cars and Sony televisions attest, and has a high household savings rate. This leads us to the focus of the video. Why is Japan's debt so large? And how has Japan managed to keep paying the interest on its loans and not default? Let's start by looking at how the Japanese government has been able to accumulate a larger and larger debt burden relative to the country's GDP, yet still pay very little interest on each new issuance of debt. In normal financial markets, the relatively larger the debt income or GDP, the larger it is for the borrower to service. We'd expect that as this debt grows, investors would demand a higher return to compensate for this increase in risk, what's known as the risk premium. Think of it this way. Your credit card company wouldn't let you keep borrowing more and more on your credit card, would they? At some point, they'd increase your interest rate, or even cut you off. Yet for Japan, this hasn't happened. To understand why, we'll first talk about what we're seeing in monetary policy today, what we saw in the past, and how this sheds light on the current Japanese situation. Central banks around the world are increasing their policy rates, the rate earned on deposits of member banks' excess reserves, in an attempt to control galloping inflation that's no longer thought to be transitory. The policy rate's like the hammer in your toolbox. It's simple to use and is probably the one you use most. Put simply, as the policy rate increases, commercial banks increase the interest rates on loans they originate to be at least that which they could earn by making a deposit at the central bank. This means that the total amount of new credit in the economy decreases. An increased policy rate means less credit, and it's hoped, less inflation. For example, the Fed, the central bank of the US, recently hiked the federal funds rate by 75 basis points, its largest single rate hike since 1994. The ECB and a host of other central banks around the world are following suit and raising rates. Right now, the name of the game in central banking circles is to ensure that the prevailing level of high inflation doesn't become embedded in expectations. Japan is the exception. At a two-day policy meeting that ended on June 17th, the Bank of Japan maintained its negative 0.1% target for short-term rates and its pledge to guide the 10-year yield rate around 0%. In other words, the Bank of Japan will maintain negative interest rates, as well as buy as many 10-year bonds as is needed to ensure the cost of borrowing for the government over 10 years is 0%. In other words, for free. To understand how we got where we are, and the light that this sheds on Japan's seemingly enormous government debt-to-GDP ratio, let's talk a little bit about the goals of monetary policy since 2008. From 2008 onwards, central banks tried to produce inflation to meet their statutory mandate. When policy rates reached 0%, some, most notably the ECB in June 2014, introduced negative interest rates. Yet, inflation remained stubbornly low. In the Eurozone, the specter of deflation loomed. When the tools in their toolbox were not up to the task of stimulus, central banks had to look elsewhere. Just as the advanced Western economies looked to Japan for just-in-time manufacturing, they too emulated the novel policy of quantitative easing, also known as QE, which the Bank of Japan introduced in 2001. And what exactly is QE? In short, the central bank directly purchases government bonds with long-dated maturities. This lowers the yield of that bond, and therefore the interest rate the borrower pays at issuance. The policy rate can affect longer-term borrowing costs, but only imperfectly. QE is a more exacting tool that mechanically lowers the long-term borrowing costs. It's used when interest rates approach 0% and policymakers don't want to lower them anymore. There are two primary effects of QE. 1. The money supply increases. The central bank electronically credits the seller, a large bank, with newly created cash. 2. Long-term borrowing costs are lowered. We mentioned long-dated maturities. To wrap your head around this term, Think of the various loans you've no doubt encountered. Credit card debt has a maturity of 1 month. With a car loan, you promise to pay over, say, 5 years. To buy a home, you borrow from the bank and promise to pay them back over 30 years. Now draw a line connecting all the dots with time on the x-axis and the interest rate on the y-axis. That line is the yield curve. Replace your metaphorical yield curve with the borrowing needs of the Japanese government and you begin to understand. The intended first-order effect of QE is to reduce the slope of that yield curve. The right-hand point drops closer to the left-hand point. The possible second-order effects are numerous. Credit expands if and when banks make loans with this new cash. Portfolios rebalance into riskier asset classes as investors have less access to safe government debt, which can improve productive investment. But we'll direct your attention to the most relevant secondary order effect for our purposes, the fiscal effect, or, in other words, debt monetization. As mentioned earlier, Japan was the first to drink from the QE punch bowl. Japan's so-called lost decade of the 1990s, where GDP grew at an annualized basis of 1.1%, well below the average of industrialized peers, came as a consequence of the bursting of the Japanese asset bubble. As a result, Japan entered a liquidity trap and credit crunch simultaneously. A liquidity trap is where reductions in the central policy rate have no positive effect on consumer behavior and investment. In fact, at the time, households and businesses expected deflation, a reduction in prices, so cut spending and investment. A credit crunch is where significantly less lending takes place. Banks, the balance sheets of which were impaired primarily from real estate write-offs, could not lend as much. So all else equal, credit access was diminished. Remember, nearly every household and business relies on credit to fund purchases, investments, and operations. So a credit contraction reverberates through the real economy in a meaningful way. The Japanese government responded with fiscal largesse. Japan's a net exporter, so its growing debt isn't due to persistent current account deficit. Instead, it's due to persistent government deficits. In 2001, the Bank of Japan embarked on a large-scale QE in the midst of deflation. The goal of this was to expand the reserves of commercial banks so that they could lend more and thus generate more inflation. The first round of QE lasted for 5 years and made the Bank of Japan the most hungry purchaser of government bonds in the world on a relative basis. Japan launched another QE program in 2014. We already mentioned how central banks around the world are raising interest rates. At the same time, we've seen numerous central banks, namely the Bank of England in the spring and the Fed in May of 2022, announce policy plans that will initiate its reversal. Put simply, when a bond matures and the government pays the central bank in full, the central bank will not repurchase any other asset with the proceeds. And what about Japan? Again, it is the exception. But why? There's some alchemy in QE. Here's a quick explanation. The Bank of Japan, although independent, is ultimately owned by the Japanese Treasury. The government must meet any financial loss incurred by the activities of the central bank and benefits from any gains. Remember the yield curve we drew with 30-year mortgages at the right-hand side? Now replace the metaphorical consumer mortgage with the Japanese government. QE means that the rate of interest the government pays on long-term debt decreases. The government issues the debt, and the Bank of Japan immediately hoovers up a significant percentage of the new issuance. But wait, doesn't the government own the Bank of Japan? In other words, when the Bank of Japan uses QE, is the government buying its own debt? Yes, that's exactly right. And this is where the operative term, debt monetization, becomes relevant. Under certain circumstances, the debt of the government can be funded by the central bank itself. At some point, given the mixed evidence of QE in generating inflation, we have to wonder, was QE in Japan intended to cheapen government borrowing? This, even if not intended, has worked in Japan. Why doesn't Iran or Russia do the same? Let's unpack this. First, Japan issues debt in yen, its own currency. Many other countries issue a portion of their debt that is denominated in dollars. This means that unlike, say, Nigeria, Japan doesn't need to acquire foreign currency to meet its obligations. Many emerging markets default precisely because they're unable to acquire sufficient dollars to pay their creditors. Advocates of the modern monetary theory, MMT, which states that a country's government debt burden is essentially unlimited when certain conditions hold, point to Japan as the consummate empirical example of how a government that issues debt in its own currency can never default. Here's how it works. When old debt comes due, the government can simply issue new debt to pay it off. This, of course, relies on the new debt finding a buyer. Enter the Bank of Japan, which is always willing to buy more. This is a convoluted way of printing more money and putting it in the government's coffers. Second, the great majority of Japanese debt, around 90%, is owned domestically. This means that Japan is insulated from capricious international capital flows. Finally, all those Toyota sales to foreign buyers do mean something. Japan's net external assets amount to over $3 trillion, about 25% of its outstanding government debt. This net external asset balance is 30% higher than Germany's. Japan's been the world's largest net creditor for over 30 years. Japan's able to engage in a circular flow of debt enlargement. The question is, when will it end? Or will it ever need to end? Japan has, in total, experienced net to no inflation since 1993. Only in June 2022 did inflation exceed 2%, the Bank of Japan's target. Similar to much of the world, Japanese CPI has been affected by an energy price shock. Japan has few indigenous energy resources and has ceased its nuclear energy program. Accordingly, it's one of the foremost importers of liquefied natural gas on the planet. Only China imported more in 2021. It's debatable, given the uncertain efficacy of QE and negative interest rates, whether the monetary policy and open market operations of the Bank of Japan have done much in isolation to contribute to reaching the 2% inflation target. What has occurred without doubt is that the relative increase in interest rates elsewhere have led to a precipitous depreciation in the yen. We also know that the Japanese society's grown accustomed to price stability after nearly 3 decades. Inflation, even 2%, is potentially anathema. Continued yen weakness would reduce Japanese purchasing power abroad. And will incomes in Japan rise after a long period of stagnation? It's difficult to say. Japan will likely sustain its enormous and peerless debt-to-GDP ratio. Given the country's poor demographics and extensive social welfare obligations to the elderly, it's difficult to see how the debt can be reduced. Equally, we might ask ourselves, need it be? If inflation remains around 2% with the current loose monetary regime, the Bank of Japan will be meeting its target, and the government will continue to fund itself through debt monetization. This is MMT in action. Will Japan continue to be the poster child of the new economics, with other countries around the world adopting similar policies? Or will the house of cards ultimately collapse if the debt-to-GDP ratio continues to grow to the point where it can never be paid off? It'll be interesting to follow the next steps in Japanification and how the rest of the world responds. Thanks for watching. Don't forget to subscribe. See you next week.